The warning wasn't delivered on a stage or at a press conference. It hit the global system the moment reserve managers started dumping dollars before sunrise, and the IMF realized the shift was no longer theoretical. In less than one trading cycle, more nations moved into the yuan than in the previous 6 months combined. Traders saw funding lines seize, swap desks scramble, and entire blocks of dollar demand vanish like someone pulled a circuit breaker on the world's reserve currency. Then the IMF issued a message no one expected to hear this early. Countries aren't just diversifying, they're preparing for the dollar to lose command. And the speed of this pivot tells you one thing: something bigger has already begun behind the scenes. The IMF accelerated the tension when it released updated reserve composition data showing the dollar's share continuing to slip toward levels last seen nearly 3 decades ago. Its communication, based on Koffer statistics, noted that more central banks had increased allocations to non-traditional currencies, including the yuan, as part of broader diversification strategies. The statement emphasized that high U.S. yields were raising debt service costs for countries heavily reliant on dollar financing, prompting a reassessment of risk across emerging markets. Bloomberg reported that China's cross-border currency usage expanded sharply after several countries increased yuan settlement for goods ranging from energy to machinery. The rise was most evident in Asia, where tighter U.S. policy spilled over into local bond markets, pushing governments to reduce exposure to dollar cycles. The People's Bank of China deepened its involvement by maintaining an extensive network of swap lines that provide partner economies with direct access to yuan liquidity during periods of stress. Financial Times coverage highlighted how China's role in global trade underpins these moves. With China acting as the world's largest importer of many commodities, suppliers increasingly accepted yuan to secure stable long-term access to its markets. This trend accelerated after disruptions in traditional payment routes affected several exporting nations, prompting them to consider settlement arrangements less exposed to geopolitical tension. In the Middle East, Reuters detailed how energy producers strengthened financial ties with China by increasing yuan-settled oil shipments. Record exports from Russia to China were almost entirely transacted in yuan last year, becoming a template that other suppliers evaluated as they built new payment frameworks. These arrangements allowed producers to insulate transactions from regulatory friction tied to the dollar. China's cross-border interbank payment system grew as an alternative settlement channel. Bloomberg reported that CIPS processed trillions of yuan in annual transactions, establishing operational capabilities that appeal to institutions seeking redundant, risk-diversified infrastructure. Although still smaller than the dominant global network, its steady expansion provided governments with more options when managing international payments. Argentina's experience revealed how these currency shifts play out on the ground. Reuters noted that Buenos Aires relied heavily on its yuan swap line with the People's Bank of China after dollar reserves fell during prolonged market pressure. The arrangement enabled Argentina to access yuan directly and settle imports from China without drawing on scarce dollar holdings. The mechanism reduced immediate strain on its central bank and allowed commercial transactions to continue during tight periods in foreign exchange markets. Argentina also used yuan for partial repayment of its obligations to the IMF. Associated Press reporting confirmed that the country executed several payments using yuan drawn from its swap line allocation when dollar liquidity was insufficient. This demonstrated how alternative currency channels can support countries navigating severe balance of payments stress. The decision underscored how deeply its financial operations had integrated with China's system. Financial Times highlighted that Argentine importers increased reliance on yuan-denominated settlements for industrial inputs and consumer goods. Companies found the shift practical because it bypassed volatile exchange rate conditions tied to the dollar. These transactions expanded naturally as trade between the two countries grew, reinforcing China's influence within Argentina's commercial environment. The IMF observed that nations employing these approaches must manage risks carefully. Its report stressed that diversification strategies should align with each country's debt structure and macroeconomic conditions to avoid destabilizing currency movements. Nevertheless, the institution acknowledged that high U.S. interest rates amplified vulnerabilities for countries exposed to dollar funding. Across Asia, regional agreements encouraged greater use of local currencies in trade. Reuters noted that members of the Regional Comprehensive Economic Partnership explored systems that reduce reliance on the dollar for intra-regional transactions. These structures complement China's attempts to broaden the yuan's role in supply chains linking manufacturing hubs and commodity suppliers. WTO merchandise trade rankings reinforced China's centrality in global commerce. Its position as the largest exporter and one of the largest importers gave firms an incentive to integrate yuan usage into their financial operations. Many multinational corporations adjusted their working capital structures to align with these evolving trade realities, as Bloomberg reported in its analysis of corporate treasury strategies. Sovereign wealth funds diversified their assets as well. Financial Times documented that several funds expanded exposure to Chinese markets and instruments not tied to the dollar to shield portfolios from U.S. monetary policy swings. These adjustments influenced reserve patterns because sovereign funds often coordinate with central banks on long-term asset allocation. Gold became a critical component of reserve diversification. The World Gold Council stated that central banks purchased the metal at volumes not seen in decades, responding to geopolitical uncertainty and elevated inflation. Many institutions viewed gold as a safeguard that does not depend on any single currency issuer. The accumulation stretched across Asia, the Middle East, and emerging Europe, reflecting a wide reevaluation of risk. The Wall Street Journal examined how, geopolitical events prompted institutions to really rethink their dollar exposure due to regulatory vulnerabilities. Banks and commodity traders operating in sensitive regions started seeking settlement mechanisms that were protected from potential sanctions or enforcement actions. This in turn pushed some governments to explore payment channels that could operate independently of the dollar-centric framework. The IMF's World Economic Outlook identified risks of fragmented currency blocks if diversification moves ahead too quickly. It warned that global liquidity management could become a whole lot more complicated if nations adopt divergent reserve strategies, which would reduce the ability of international institutions to coordinate during crises. Still, the report did acknowledge that individual countries were responding rationally to external shocks. Emerging economies faced, significant refinancing challenges as U.S. yields climbed. The World Bank noted that elevated borrowing costs put a lot of pressure on countries that had accumulated substantial dollar-denominated debt. Governments in this position started weighing the benefits of accessing yuan-based financing from Chinese policy banks to help alleviate short-term liquidity constraints. The Bank for International Settlements observed that China's swap lines acted as stabilizers during episodes of market turbulence. Several countries drew on these lines when accessing dollars became expensive or uncertain. The BIS highlighted that these tools contribute to financial resilience by providing alternative liquidity sources. China's digital currency development accelerated experiments on cross-border payments. Reuters reported trials between China and partners in Southeast Asia testing faster and more efficient settlement using digital currency infrastructure. These tests suggested that new financial technologies could expand transaction options beyond the traditional dollar-dominated system. Commodity producers adjusted to shifting demand patterns by accepting yuan-denominated payments for metals, energy, and agricultural goods. Bloomberg noted that these arrangements improve predictability for exporters working with China, their largest customer in many sectors. The trend supported greater tolerance for holding and managing yuan assets. Sovereign credit conditions in the United States influenced reserve decisions worldwide. The Congressional Budget Office projected high deficits that require substantial Treasury issuance, increasing reliance on foreign buyers to maintain stable yields. Reuters reported that several central banks moderated their Treasury purchases as they fine-tuned reserve allocations, a change that can influence global bond markets. The IMF's cautionary language signaled that it recognized accelerating momentum behind these shifts. Policymakers monitoring reserve patterns understood that a broader rebalancing was underway, shaped by structural economic changes rather than short-term trends. The evolving landscape reflected global efforts to hedge against volatility and maintain stability. Argentina's deepening engagement with yuan financing illustrated the pressures driving reserve transformation. With limited access to affordable dollar funding, the country found yuan-based instruments essential for maintaining liquidity. Its experience demonstrated how fragile dollar-dependent economies can become when external conditions turn adverse. This vulnerability encouraged a broader rethinking of financial architecture across emerging markets. China's government bond market attracted foreign interest after inclusion in major global indices. Bloomberg reported that asset managers adjusted portfolios to reflect the new weightings, increasing exposure to yuan-denominated debt. This inflow expanded the yuan's presence in international investment portfolios, reinforcing its credibility as a reserve asset. Financial integration between China and commodity exporters accelerated as long-term contracts incorporated non-dollar settlement provisions. The International Energy Agency noted that these provisions lowered transaction costs and reduced sensitivity to fluctuations in United States monetary policy. This alignment supported smoother trade flows during periods of global uncertainty. The IMF's warning underscored a central issue. Shifts in reserve composition reflect deeper structural trends that alter global financial balance. As countries diversify their holdings, the dollar remains dominant but no longer unchallenged. The gradual rise of the yuan within trade and finance demonstrates how alternative systems gain traction when economic incentives and strategic considerations align. In the final hours of trading on the day the IMF released its warning, markets showed heightened volatility across currency pairs tied to emerging economies. Traders attributed the movement to rapid adjustments from institutions recalibrating their expectations around reserve dynamics. The reaction suggested that underlying structural change was influencing short-term market behavior. The broader question emerging from these developments concerns how global finance adapts as economic gravity continues to shift. Nations evaluating their strategic positions weigh the benefits of long-standing arrangements against new systems offering fresh forms of stability. Argentina's reliance on yuan liquidity offers a glimpse of what that transition looks like under pressure. Across continents, governments balancing risk, opportunity, and sovereignty reshape a system once defined by near unquestioned reliance on the dollar. Whether the next phase of this transformation accelerates or stabilizes will depend on choices made by central banks confronting a world where financial power is dispersed across more than one axis. The IMF's message highlights the stakes but leaves unanswered how far the shift will travel when the pace is set not by institutions, but by the accumulating pressures of the global economy itself. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.